Right, good day, grade 12s. This particular lesson is actually a revision on grade 11, and it's also therefore relevant for any grade 11 who happens to be listening to this. One of the things that we need to know before we move into our inventory valuations or into our cost accounting is to know the difference between the perpetual and the periodic stock systems. Now, up to this point in your accounting curriculum, right from grade 9, you've been working with the perpetual stock system. So the perpetual stock system, we've got our stock of tins here, and there's 12 tins that are sitting here. This would be recorded in a computer. They would record it when you bought it, and they'd record it at the price at which you bought it for. As you sold those tins, they would be scanned via a computer, and not only a till slip will be produced showing the selling price of all of those goods, but at exactly the same time the cost of sales would be produced. So the cost of sales would be showing the number of tins that are going out. So in this case there were 3 tins that went out on the stock, and so therefore the computer system can show us that there are now 9 tins left over, which we can go and count, and that's where we get our trading stock deficit is. The important thing is that as the sale takes place over here, the computer is scanning and you know exactly what the cost price of the goods you sold, so you know your cost of sales. If you were therefore to draw up a trading account is the account that we use to calculate our gross profit. Now please, there's a difference between a trading account and a trading stock account. The trading account is just your sales minus your debtors allowances, which is at a selling price. The cost of those goods, which is like equivalent to the 3 tins that were sold, and you can work out your gross profit. Or you would do this in an income statement, sales minus debtors allowances less your cost of sales. Now under the periodic stock system, we would still have our stock of what we bought, because we know what we bought. We've got invoices when we bought, and we know that we've got 12 tins. As we're selling though, the important thing is that this system under this a business that uses the periodic stock system would not be able to calculate the cost of sales. It's like the old-fashioned till points that we used to have, which you often find in small shops and tuck shops and that way, where they will ring up the selling price of the goods. It becomes like an adding machine to you. It'll still produce a till slip and show the customer what they owe, but there is no connection to the stock at that stage. That arrow to the stock is actually missing, because it does not show how many goods have been actually sold. And so the only way this business would know how many goods that were actually sold would be to actually go and count what was left. And in this particular case, let's assume we know that we had 12 because we bought those and the invoice showed us. We go and count and we see that we've only got 3 tins left over. We would therefore assume the difference between these 12 minus 3 is 9, and we would assume that those 9 have all been sold. You don't have them any longer. Alright, so there's no way of the system calculating a cost of sales for you. So therefore you lose a bit of your control, because while you will know what has gone, the difference between what you had and what's left over, the 9, what you won't know is whether any of those have been stolen. And so you won't be able to control any stock losses that could be taking place. So therefore the trading account under the periodic stock system looks very different. You'll notice that there's no cost of sales here, because we don't have the cost of sales. Cost of sales has to be calculated. So we would start off with our opening stock, the stock we had at the beginning, plus we will add on our purchases of all the goods we've bought, plus we would add on any other expenses, carriage on purchases like they've got here, or import duties. Now under the perpetual stock system under which you used to, those 3 would have been combined together in the trading stock account. We would still have our sales on the opposite side. We would then go and work out our closing stock by counting the number of items that have got left. So we know that although we had these goods over here to sell, there, that's what we had to sell, we haven't sold them all, so we will minus them. So we will put our cost of our closing stock on the credit side. And then the purpose of a trading account, remember, would be to work out your gross profit. As I said earlier, it's the same as under the perpetual stock system. And so if you balance this account, you will find your gross profit, which goes to your profit and loss account. What this account is not showing you, though, is what the cost of sales actually is. It's there, it's embedded in these figures. So let's go one step further and let's look at it, how we could calculate the cost of sales. Now, using the exact same figures as I've just shown you in a ledger account, you've got your opening stock, plus your purchases, plus your carriage on purchases, and if you add that together, you've got goods cost you $91,200. That's what the cost of the goods available to sell. So those goods, the opening stock, plus what you paid for the goods, plus the carriage or import duties, they cost you $91,200. You now go and do a stock take, and you calculate your closing stock, which comes out at $35,000, and subtract $35,000 from it, gives you $56,200. So there's your cost of sales. So you can be asked to do a trading account, or you could ask to calculate the cost of sales. So it's just adding up and subtracting the closing stocks. They might go one step further and ask you then to work out the gross profit. We know that gross profit is sales less cost of sales. So using the same figure, our sales was $86,600. Subtract our cost of sales there, and the gross profit, which is identical to what I had in the ledger account, is $30,400. In this method, it's a lot easier to understand. So looking at it from this point of view, under the perpetual stock system, you are given the cost of sales, and then you can go on and work out the gross profit. In the periodic stock, you have to first calculate the cost of sales, and then you can work out the gross profit. Now, you need to know this calculation and the trading account, because you're going to do it now as we move forward into inventory valuations, as well as into manufacturing later. And for you grade 11s, you will be doing also manufacturing, so you will also have to know this. So so please, there are some exercises in your book before we get on to the next section of work, and so please just make sure you understand this calculation.